the great Ailie Elmore. Ailie, thank you for joining us today.
Thank you so much for having me. I don't know about great, but
Ailie teaches quite a bit of things with me at the University of Illinois. We actually taught a class together early in our journey of getting to know each other. And Ailie teaches a sales class. She teaches, I think, some sort of ag eco class, and she also teaches an investments course, which is why I wanted to talk with Ailie today. And Ailie is also graciously our co-host on Lemoine and Everything Else podcast. So, Ailie, great to meet you.
It's very excited to be here, Craig. Yeah, I'm super excited to be a part of the podcast and a part of alternative investments and kind of getting to dive deeper into a bunch of different topics that I am interested in learning more about as well.
So today I really wanted to chat with Ailie, both kind of a little meta about what we're going to be doing together on this podcast, right? The purpose of it. And then I think also just from an investment standpoint, that's one thing Ailie and I have in common. I taught about 9 years of CFP investments and a couple of other type of investment prep classes, right? And Ailie teaches investments right now at U of I as well. I guess let's talk a little bit about when we get to alts in an investment class, right? So one of the things that I'm hoping to bring more depth is that I remember when I went through my certified financial planner training and you get to investments, right? So it's like one section amongst many. And then you're going through and it's behavior, and then you've got all the calcs, and you've got like, your CAPM, securities market line, all that stuff. You've got identifying equities, features of bonds, you've got duration, you've got all this content. And then it's like, okay, so here's everything not stock and bonds. We're going to cover it in a week, and now we're going to move on.
Yes,
right. And so you wind up with this cursory knowledge that there's these things called hedge funds. You understand that there's this thing called private equity, but you probably don't want to use it. There's this thing called private debt, but why don't we just use mutual funds, right? And that's kind of the takeaways that you got. So, I think from that end, it's always been a challenge to me when we get to alts in an investments class, usually towards the end of the semester. You've already got students and their learning level's pretty high. But, how have you taught it? You've taught about 4 or 5 semesters of it now. So like, how have you gone about teaching alts to undergrads, and would it change in a grad class?
Yes. So I just started incorporating more alts training. I was always covering derivatives trading in particular, kind of just maybe the structure of derivatives trading when it comes to commodity trading, as well as S&P futures, because so many of the students, it's interesting to me how many of the students don't understand that you can actually buy shares of like the S&P fund, like the S&P index. They think it's a fund that you can buy shares of.
Sure.
So we kind of talk a little bit about the structure of the S&P futures market, and then dive a little bit more into kind of a little bit of strategy, and go into options pricing, cover a little bit of Black-Scholes. If we're looking at a graduate level course, I would expect more of the actual Black-Scholes modeling being done for option pricing. But in my undergrad course, we talk about it, and I tell them where they can go for more information. There's just unfortunately not a lot of time for it. Then moving on to, I do like an entire week on just derivatives, a lot of quantitative analysis. How do we calculate a margin call? What is, posting margin? How do we clear accounts? Things like that. What is open interest volume? And then I just started recently incorporating what I call my week of alternative investments, where I talk a little bit about everything. The big ones I like to hit on are real estate, because most people, they think of real estate as an investment class, but they don't actually think of it as an alternative investment class. Talk a little bit about private equity. Venture capital is always something the students are really interested in, because it's usually those more, risky ventures. I have a student who went to go work for a venture capital firm in Houston. And those are kind of like lots of startups, getting businesses off the ground. And then obviously all of my students are very, very interested in digital assets.
Oh, sure.
All of them.
Yeah.
And when it comes to that space, they initially think, okay, cryptocurrency, like Bitcoin, meme coins, things like that. But we try to talk a little bit more about digital assets is not just cryptocurrency. There are, what we refer to as tokens or intangible like patents and things like that actually fall under that digital asset category. We also end up talking about how like fine art is considered a alternative investment class. I tell my students, you're not here to learn about how to have an eye for art. You got to take an art class for that. But it is a space, particularly if you look at your high net worth clients. Some of those high net worth clients have significant collections of private works in that space. Primarily spend the most amount of time, like I said, in the real estate space, just because after, stocks and bonds, that's probably going to be the thing that they encounter the most in their professional career.
Well, and I would think also to some extent their personal career, right?
Yeah.
Like personally, is a recent grad likely to get into that? Well, it's possible.
Yeah.
They could take that route. So I like that. And I know we also spend a lot of time on, puts and calls and your traditional equity option contracts as well. I wouldn't consider that an alt necessarily, but a derivative, I think we could throw that in. So, one of the things I'd like to kind of get into with you, and I guess pull from, I know that you've researched and your dissertation was sort of in the alt space, right? Mm-hmm. So when you get into real estate and you get into these other asset classes, what comes to mind for me, of course, we look at correlation and we kind of get to this elephant in the room, that like even stocks and bonds, right? Mm-hmm. They walk up the escalator together, right?
Yes.
They both have that some commonality. So how do you address that when you're talking with undergrads? When you start bringing up alts, how do you throw that out there?
Yeah. Well, so when it comes to, if I'm examining it from, the perspective of at this point in time in the semester, they understand correlation, they understand covariance, and they understand the importance of analyzing how a portfolio performs against rising inflation, which was really interesting. The past couple of years post COVID, my students have been able to experience that, where they've seen rising firsthand inflation and what kind of effects it's had on equity and bond markets in particular. And so when we talk about alts and the benefit they can play in like a mixed asset investment portfolio, a lot of times those have a positive correlation with inflation, particularly if we're looking at, we'll talk about farmland, as well as some other, even some of those digital assets have historically a positive correlation with inflation, meaning that as inflation rises, typically the value of those assets rise as well. So that's kind of how I set the stage with the students to be like, this is why you should be interested in this, because inflation is something that's never going to go away.
No, turns out.
And you have to continue to protect yourself as well as your client's portfolio against it. And so I kind of try to set the stage up of, well, here are the market factors, and this is why alts could be a really great option for you or for your investment clients.
So when we get into working with undergrads and how we teach this kind of stuff, what are some things you're doing in the classroom, right?
Oh, yeah.
That go beyond PowerPoints, right? Like how do you go a little deeper? And I guess to any of our fellow professors or instructors out there, we'd love to learn a couple of things from you.
Absolutely. So I actually don't use PowerPoints. I am a little old fashioned in that I use like actual handout notes that I do a fill in the blank system, and where they have to fill out the formulas themselves. And so on my setup for pretty much all of my classes that are financial planning or investments based, I have a setup where on Tuesdays you come in and we just dive into content. We dive into the theories behind it, the math, especially in a lot of the quantitative things when we're getting into how do we calculate risk-adjusted returns. I typically then have the last 15 minutes on my classes, typically on the first day of the week, where we do an in-class activity. Typically, I like to do group work because I love when the students challenge each other and start asking each other questions. And so that's kind of like how I structure my first day of the week. My second day of the week, because I typically just teach twice a week, is all Excel models. So I have built, with the help of yourself and as well as Bruce Sherrick, who I know will be a guest on this podcast, several Excel models applying the content, where the students are given real world problems. I usually pull real data from Yahoo Finance, the Fed, or wherever.
Or the Wonder Bucket.
The Wonder Bucket, yes.
For those of you,
talk about that.
The Wonder Bucket is actually a way of teaching sequence of return risk,
Yeah.
right? So you have a bunch of actual returns in a bucket, and you ping pong balls, and you literally pull them out, and you show how, from a geometric mean standpoint, it's always the same, but from a sequence of return risk, you can start retirement, and if you get 3 negative returns, oh boy, it's a totally different retirement than if you get positives, but yeah, the Wonder Bucket.
Yeah, so I typically do the Excel models on the second day. It's kind of a 2-part. One, it's great because the students love working with the real life data and understanding it, and it's a way for them to apply, like, how do we, use modern portfolio theory to create, a portfolio with the highest Sharpe ratio? Or how do we create a portfolio that's diversified against, interest rate risk or things like that? And so I love being able to do that kind of application for that reason. And all the employers I talk to, one of the biggest skills they want their students coming out of, graduation to have is really great quantitative skills in Excel in particular. We're definitely seeing more employers wanting coding experience, more data science experience. But Excel is one of those platforms that is readily available across any business. And so I try to teach, students those skills in that platform as well. That way they, have it to carry into
and I
their
think
future
from
career.
Quantitative data analysis, right? That piece of this business, that's one that we definitely need to have a certain background or pedigree, right?
Yeah.
And that's the whole idea behind a lot of the things we look at. Off track from alts a little bit, but when we look at things like a certified financial planner, CFP designation, we're kind of presuming everyone has this like base level quant skill, right? It's like, okay, so we're just going to kind of assume all 100,000 CFPs have that base level quant skill.
Yeah.
And I think that that's one of those things where, we talk a lot about behavior and counseling and coaching today, but without the base level quant skill, the behavior counseling and coaching doesn't have the impact that it would if you actually had that skill set in place. So by all means, keep that up. That is just fantastic stuff.
Yeah. Well, and nowadays there's so many awesome financial planning softwares that can do the math.
Yeah, but you have to understand it.
But they have to be able to
You
understand
absolutely have
it.
to understand it.
Yep.
So on that note, I help out with our capstone class, right? And I did last year, again this year for a few weeks. And one of the things I love going in and doing is just kind of just a redonkulous time value money problem right off the bat, right?
Yeah.
Like extra hard, extra crunchy, not fun.
Yes.
And that's how I start day one. I'm like, all right, here's what we're going to do. Now, what do we learn from that? And the point being that I want to rattle the cage a little bit on purpose, but I'm doing that to the standpoint of saying, great, we're going to talk about the behavior and the counseling and the coaching. And maybe you can BS your way through some of that.
Yeah.
But you really have to know the underlying kind of structure of it all to get to that point. So we're going to do that. It's going to be a lot of fun. They don't know it's coming in 3 weeks, but they're going to be amazed. So I guess back to kind of your experience, you grew up farming and you've wound up teaching investments.
Yes.
So draw that path for me. How did one get to the other, and how do you find those kind of farming principles in what you do every day?
Oh yeah, I love answering this question. So, I grew up on a row crop farm. We grew corn and soybeans in central Illinois, just south of Springfield, about an hour and 45 minutes away from campus. And so agriculture was always that thing that I was like, yes, I am always going to be involved in this industry. But I actually also grew up in a banking setting. So my great aunt owns a small community bank in our community that my dad's been the president of for several years now. And so I grew up, especially, both my parents worked very hard. And so I spent a lot of days at the bank with my dad. And, I would sit in the corner of his office. He usually would give me like a stack of $1 bills or something to play with, and I'd have to give it back at the end of the day, unfortunately.
I hear that's the thing.
Yeah, unfortunately. And I would sit there, and for the one thing is I initially got interested is I just loved the feel of money. I loved counting it. I loved playing with it. And then I got to witness the conversations my dad would have with people in the community and, the impact he was really making at the community level when it came to, providing loans for people to start up businesses, providing farm loans to ensure the success of, farm families. And so I kind of grew up in that banking finance setting, and then I don't want to say my brother kind of set the stage, but he worked as a commodity trader initially, and absolutely loved that kind of more like high finance, and then now works for a very large financial company out east. And so I kind of got that exposure, right off the bat. So I knew I wanted to go into finance. And then I studied, agriculture finance in my undergrad. And that's where I discovered that there was this really cool asset class that was right out my back door.
Yeah.
And I had no idea.
Absolutely.
Yeah. So I did all my graduate work researching farmland markets and the structure of returns, how it could be, put together in a mixed asset investment portfolio, why people are so crazy about it when it comes to institutions, and, the benefits that it can really have for people with that long-term investment horizon. And so that's kind of how I got from point A to point B. I'm still very passionate about both. And then along the way, I've been able to pick up skills in actual personal finance, how to help people manage their money effectively. And I absolutely love that, because even my students that are studying, animal sciences or history or English or engineering, they all still need to learn those skills.
Absolutely.
And so I love being able to interact with people in that way, because financial literacy is something that people don't like to talk about because it makes them scared because it's money, but it's something that's going to affect everyone at some point in their life.
And I think you and I share that commonality.
Yeah.
One of my true joys of my career right now is being able to teach personal finance at scale to that many different students on campus. And I think if you stripped away all the elements of what I do at Illinois, and I had to sort of hold on to one, right? I think I would hold on to that one, right? Is that kind of idea of all right, the ability to teach what a mortgage is and what credit cards are, and, some basics of personal finance and checking and investing and wealth management, and then just kind of this idea of what risk is, right? And how we only really want to focus on the fun goals, and we really don't want to focus on the scary things, right? And that's a very drilled down discussion of risk. But I think at the end of the day, everyone wants to start a college account, or when they have a kid, no one wants to talk about dying. And I think that's the precipice of some of what we talk about. But, that personal finance element rings very, very true. So from there, you've picked up investments, you're on the path to the CFA. And I guess I'd like to bring your research in, right?
Okay.
And I know I'm kind of springing it on you, right? But Ailie's dissertation was very interesting to me because it's in this idea of alts and it's in this idea of asset classes. So why don't you share kind of the basics of what you studied and what you found out?
Absolutely.
We'd love to hear.
So I had the opportunity to study under Dr. Bruce Sherrick, who I know you'll be interviewing at some point in time. And he is like the farmland market guru. He's the one that really interested in me when I initially started my graduate studies and my research. I thought I was going to do something related to agricultural credit institutions. So let's evaluate commercial banks and, the large companies that are lending to agribusinesses and farm families. And through my research, I really developed this interest in farmland, particularly in the point of time that I finished my graduate work in 2021 was we were just, 1 year out from the COVID-19 pandemic, and we saw this huge interest in farmland as an asset class. And there were definitely institutional investors that had already been part of that as well. But we saw more interest because people figured out, even when the world is going crazy and might be shutting down and people aren't driving cars or aren't going to the movies or things like that, they still have to put food in their bellies.
Yeah.
And so that people started to flock to farmland as an investment class because of that reason. So that's kind of what drove my true interest. And so I wanted to evaluate, how does farmland fit within a mixed asset investment portfolio? like what is the optimal percentage that your investment portfolio should be in? What kind of Sharpe ratio does it have in comparison to a, typical, stock and bond portfolio? And so I evaluated Farmland, initially started by creating my own index. So I created what I called the Elmore Farmland Index at the time, where I took the top 10 states that you can institutionally invest in. So there are a few states that have anti-corporate farming laws that make it a little bit difficult for investors to actually invest in. And so I excluded those, but I took the top 10 states, Washington, Oregon, Illinois, Florida, Texas, among others. And I evaluated the returns of that index for the last 50 years. So it was my work was from 1970 to 2021 or 2020, and how it interacted with other investments. Over the long term, Farmland had just about a 10% return, just over a 10% return in comparison to about an 8.5% in comparison to like AAA bonds. Just under that, just around 8% was the actual value of the S&P.
Sure.
And so I created a portfolio of, the S&P index. You can't really, invest in it, but it's good because it's a value of, large cap stocks, and against AAA bonds, BAA bonds, the 10-year treasury, since Farmland has a longer hold period typically, and U.S. farmland. And so I calculated what the optimal percentage, and I'm not going to say what it is because you should invest based according to your own risk and your own objectives. But it was a really cool way for me to study farmland markets. I found out kind of what the main drivers of when we think of how returns are realized in farmland, we think of, the appreciation. So how the value increases through time, and then the income generated. For a farmer who is operating that land, the income is selling their crop or selling livestock or things like that. For an institutional investor or a private investor, they are owning the land and then renting it to the farmer. So the income earned off of that is similar to like your apartment rent,
sure,
or something like that. And so evaluated the structure of those returns, what is truly driving income and appreciation, and then how it interacts particularly with inflation. So that is kind of where Farmland got its name to fame, is it's got a very, very strong correlation with inflation, which we've experienced over the last 3 to 4 years. So we've seen, very high inflation year over year since the COVID-19 pandemic. And we've seen farmland values increase, particularly even in just the Midwest, 20 to 30% year over year. And so that's kind of what really drove my research. I had a lot of people that were really interested in the research I was doing, but for me, it was like a really explorative process of really truly diving in and becoming like a mini expert about something that was like I grew up right next to,
sure,
like in my backyard. And so it was a really, really cool, research project.
And that's good. That's the process of dissertation,
yeah,
right? Is like learning the methods and everything you go up to, and then becoming that expert in that
yep,
piece of the pie at the
absolutely,
top. Yeah, that is a fantastic journey. And I guess to that end, a follow-up question to you. You were talking about drivers that are pushing value, right,
mm-hmm,
of farmland. What are 2 or 3 of those drivers, inflation aside?
Yeah,
I'm going to take that off the table.
I wouldn't call inflation necessarily
drivers.
A driver.
Okay.
It's it's a driver of a driver, I would say. So one of the big things that drive farmland values is, prices of the subsequent products it's producing. So when we think, I talk a lot in terms of corn and soybeans because that's what we're,
sure, known
for in the Midwest. But when we looked at commodity prices during that point in time, we did have a few different factors at play. We had a supply chain that was backed up, causing the prices of food everyone saw in the grocery store
yep,
to go up. We also had a geopolitical conflict in Russia or in Ukraine with Russia that really caused a lot of friction in markets. if we were talking about, the breadbasket of the United States, we think, Midwest. When we think about the breadbasket in Europe, we think Ukraine, in that Eastern European part. And so when Russia invaded Ukraine, commodity markets went berserk because Ukraine is the top producer of wheat. It's one of the top producer for several other types of grains. And so as we saw commodity prices go up, that would, be driving income, which would then be driving values of farmland. And so that was one of the main drivers. One of the other big drivers was, only about 1% to 2% of land transfers in Illinois in particular every single year. Land is very closely held among, private individuals, farm families, or somebody who, their grandparents farmed, they no longer live on the farm, but they still hold that farmland. And so what we saw during, COVID-19 or post-COVID-19 is we saw a little bit of an increase in the amount of transactions, part of it being driven by very, very low interest rates. So we had very low interest rates during this time. It wasn't uncommon for somebody to be able to finance, below 3% on a, 10, 15, 20-year farm loan. And so obviously if it's cheaper to borrow stuff, that stuff is going to become maybe a little bit more valuable as a result, because there was more demand as a result. And so, now that we've seen interest rates rise, it's interesting. We've seen the amount of transactions slowing in the farmland market, but we haven't really seen values back off too much. So those are some of the main drivers. There's other drivers more regionally. So if we were talking about the western part of the United States, California in particular, water rights are a huge driver of land prices. If the land doesn't have water rights associated with a property, it is going to be worth, 3 or 4 times less than a property with water rights, because, California has historically been a very water depressed area. Right. And so the other thing you have is maybe developmental pressure, particularly we're seeing competition for more green energy. So obviously if we're putting up solar panels on farms, those farms can no longer produce. Right. And so you are seeing more competition from that end. Battery storage is also a huge thing out in California as well, where we're seeing land prices being driven by people needing pockets of land just to store these massive batteries. And so seeing there's lots of regional effects that we're seeing as well, not just on a national scale.
That is fascinating. So thank you for sharing that. I love those. That's fantastic. And that's a huge value add. So thank you for that today. Mm-hmm. So I want to kind of ask 2 more questions for you. Okay. That I ask every guest. Oh, great. And so as you'll be hosting, good to get the questions down. The first question it's the sort of the case study question, right? Mm-hmm. You've got an investor, let's say someone that does not actually want to actively farm. Yeah. But they want farmland or some sort of commodity or exposure in the portfolio. Yes. Let's say it's a me, right? Yeah. Right? No experience farming, but I've got equities and I've got bonds, I've got international equities, and I would like additional asset class exposure. How do I get it?
So there's a few different ways, depending on the amount of money you're willing to put forth. There are 2 farmland REITs that you can actually invest in. And those 2 are kind of your way to get, easy exposure. You can go out and,
so buy. If I've got 10 or 100,000, maybe that REIT's the maybe that REIT is the way to go. If you have more than maybe 100,000, let's say, maybe you're an accredited investor, you can start looking at maybe a fund investment. So there are several funds that invest in farmland, and there's several funds that invest in farmland that can be tailored to your unique preferences. So there are funds that invest in farmland it's all organic farm. So
They use all organic practices. There are funds that invest regionally, so that are only in California or the Midwest or maybe Florida or Texas, places like that. There are funds that invest in qualified opportunity zones, which we're going to have a guest I know that is going to be talking a little bit more about qualified opportunity zones and the tax benefits associated with those. And so if I'm looking at a private investor that doesn't want to have doesn't want to just go out and buy land and manage it themselves, looking at more of that fund level investment is going to be the right choice. And then there's several different options based on their preferences, their risk preferences, their horizon as well. That's the other thing about farmland is we say you really need to have a 10-year hold or more to really achieve those benefits and achieve that long-term horizon. We've seen very strong appreciation levels over the past few years, but that hasn't always been the case. There have definitely...
And it's hardly liquid.
Yes,
right?
That's the other part.
I mean, that's your 10-year hold's a very important point to this.
Yes.
Because it's not something where, okay, I'm going to put my $200,000 away. All right, 3 years later, I need it back. That's not what land doesn't transfer quite like that.
Exactly. It's a really good point I haven't brought up. It's incredibly illiquid. And you also, if you own it outright, you have to manage it.
Right.
And for somebody who is, investing in a fund, the fund manager takes care of all of that. They usually have a property manager that is going to manage the properties if they're not doing it themselves. And so you as the investor, that takes out some of that hassle. Now, if you are a private investor looking to buy, directly into farmland, then you're going to have to manage it yourself, which a lot of times most private owners, private investors, I should say, a lot of times they're going to do what's called just a straight cash rent lease, where you're, leasing the farmland to a farm operator to use. But then the owner is still responsibility for making sure taxes are paid. If there are any improvement projects that need to be done, like drainage tile or pivot irrigation or things like that. And so that's where we see a lot of the institutional capital is kind of more in that fund level space. Definitely some in, the REIT space as well.
Great answer. Thank you. My last question.
Okay.
So I'm a financial advisor. I'm an insurance agent. I'm a broker. I'm an intermediary. I work with consumers and I give them financial advice. Mm-hmm. What do I need to know about alts? How do I learn about alts? Where do I go for that knowledge? And I think from the standpoint, this may not be, full time, but where do I go next?
Yeah, that's a really great question. For me, where I get my information about the space is obviously dependent upon sector. So there is really great, if I'm looking at real estate, I look a lot at, the Wall Street Journal, CNBC, Bloomberg, in particular, as well as looking at maybe some more private sources like The Economist. I really enjoy reading. They usually have some real estate pieces on that as well. When it comes to more of cryptocurrencies, derivatives trading, kind of more in that space. Even Seeking Alpha has some really great information in that space. When it comes to maybe more farm information, that's kind of my area of expertise that I spend a lot of time in. There are lots of local places that you can look to. AgWeb is one. There's several there's lots of institutions that pride themselves in research in this area. The University of Illinois being one. So we have the Center for Farmland Research, which Dr. Sherrick is the director of, and I have helped with in the past. And so if you're looking for information about the structure of returns, about more up-to-date information about, what's going on regionally, that would be a place that I would maybe direct a listener to.
Well, Ailie, love your answers. Thank you so much for joining me today.
Great. Thank you so much, Greg.